Hi, welcome to the next subject in Level 1. So this is part of Module 2 and it is Subject 2.5.1, Introduction to Bonds. Okay, so this is what we're going to cover in this session. We're going to start off looking at the fundamentals of bonds, the main piece of terminology you're going to come across, and also the alternative names you might come across on your desks for each of these terms. We're then going to look at the price of the bond and how that's derived. And after that, we can look at some of the more detailed features. We're going to examine accrued interest and what it means when people talk about clean and dirty prices. We're then going to look at the covenants you might find on bonds, the type of security that bonds may have, and then how bonds may be subordinated to one another or to other commitments the organization or issuer has. Okay, so the best way to explain a bond is to actually look at an example. So a bond is effectively a loan. It's a loan to a company or a government. Now, obviously, you or I aren't going to lend a couple of £1,000,000 or £100,000,000 to a company or a government. Well, the great thing about a bond is it's a loan which is broken down into parts. Now, each of those parts might be £100 or $1,000 or €100, and so therefore it makes it much more manageable to be able to lend that amount of money. Now each bond is equal in that it gets exactly the same treatment by the issuer, the borrower. And so therefore in this case, let's go straight to our example. We have a company you may be aware of, so the large retailer Walmart. Now they've issued a bond with a $1,000 nominal. Now we'll come on to the exact definition of nominal in a moment, but the 1,000 effectively means that for every bondholder that's out there, Walmart at maturity of the loan, maturity of the bond, will pay back that 1,000 to whoever holds the bond at that time. Now, how much will they pay you in the interim? Well, this is where we have the coupon rate of the bond, which in this case is 6.5%. So what Walmart are promising is on an annual basis, as coupons are always quoted annually, they will pay 6.5% of $1,000 to whoever holds the bond. That 6.5% may be paid in a couple of installments. We'll talk more about that later. And they're going to continue doing that every year until 2037. So effectively, the investor is going to buy the bond initially from Walmart, and in return, Walmart will give them the bond. Walmart will then give them the coupon on a regular basis, and then finally a return of the nominal value. What risks are to the investor? Well, obviously if Walmart aren't able to afford to pay the 6.5% of the 1,000, which in this case would be $65 a year to all of the bondholders, then they are in default, and that's when we start looking at how we get recoverables, which will be covered later on when we start talking about subordination. Now this page is good for reference. Most of it we've already covered in the previous slide, but again repetition is the best way initially to get your head around these things. The other reason for this page is to talk you through the alternative names that you may come across for each of these items. So first of all, we have the bond being issued on a particular date, and the bond is broken down to smaller pieces. That we've already covered. We also talked about the nominal value. Now the nominal value, remember we said, is the amount that's paid back by the issuer at the end. It isn't the amount that you paid for the bond initially. It might be very close to that, and we'll look at that later, but it's the amount that the company is promising. Whoever owns this bond at maturity, the nominal value is the amount we'll give you back. That can also be called the face value or the par value of the bond. It means exactly the same thing. The bond will then pay this interest rate on an annual or semi-annual or even quarterly basis. It's always quoted annually for ease of comparison with other bonds, and another name for the interest on a bond is the coupon payment on that bond. The maturity date we've already mentioned. Again, another name for that is redemption. And then just a few pieces of terminology which you will hear throughout the CFT, and that's the notion of when companies raise finance through either equity or debt, there's an issuance process and then the subsequent trading of those instruments. Just like for every other instrument, the issuance of those instruments is called the primary market, and the trading onwards after that, every day after that, is known as the secondary market. Okay, so what we have here is an example screenshot from Bloomberg for a bond issued by Walt Disney. This particular bond isn't the bond we were just looking at a moment ago. This is another bond. Companies will often have many, many different bonds in issue. And so therefore we've got a few key things that I just want to pull out from this. First of all, at the top you can see the issuer of the bond, which in this case, as we mentioned, is Walt Disney. Other than that, things that we've already looked at. First of all, we've got the nominal value. The nominal value of this bond is $1,000. Now, is Walt Disney really going to be borrowing $1,000? No, they're not. And that's when we come on to the issue amount. Now, something just to be aware of here. Now, you notice the number on issue amount. You can see there it says 300,000, and then in brackets there's an M. Often people think the M stands for million. In reality, M equals 1,000. So therefore this is actually 300,000, which is equivalent to $300 million. If indeed the amount was millions, then rather than M, it would actually have MM written beside it. Now what else do we have on the screen? We've got some other key things that we've already mentioned. First of all, maturity. This bond matures in December 2017 on the 15th. Now when was it issued? You can see that it was issued on a very similar date to that, on the 19th of December 2002. So this bond is said to be a 5-year bond. You could actually say it's 5 years less 4 days, but we'll just round that and say it's a 5-year bond. The coupon, very important. Remember, that's the amount that's going to be paid, and we can see quite a few things here. It says 5 7/8%. Bonds have been around for quite a long time, and before the age of computers, it was easier for people to quote quarters, halves, eighths, 16ths%, rather than talk a long decimal number. With the advent of computers hasn't changed that, and therefore bonds traditionally will still pay quarters, halves, or eighths of a percent as their coupon, and this is no exception. It's 5 7/8. You can also see, hopefully just off to the left hand side, S/A, which means this is paid semi-annual. Now, we haven't gone into enough detail to say exactly how at the moment you turn that 5 7/8 annual number into a semi-annual, but I can tell you for this particular bond, all you actually do is divide it down by 2. And then the final thing to note, and can be a little confusing the first time you see this, it says the issue price for this bond, 99.1170. Now, that might seem a little confusing because I've told you the nominal value of this bond is 1,000, meaning if you buy this bond, you will get $1,000 back in 2017. Now, paying $99 for something you get $1,000 back in only 5 years' time is a pretty good deal. Well, actually it's too good to be true, because actually when quoting prices of bonds, we quote the price per 100 of nominal value. So I mean the price of this at issue was $99.117 for every $100 of nominal value. Now we know the nominal value is 1,000, so this actually means each bond was issued for a price of $991.17. Why do this? Why confuse things? Well, bonds have different nominal values. Some are 100, some could be 1,000 or even larger. By quoting the price as a multiple of 100 of nominal value, it aids comparison between different bonds with different nominal values. And the final thing just to note, if you can see at the very top up here, we have the current price of the bond, and that's the bid offer spread. We see bid offer spreads throughout the CFD. And that means that if I was to buy this bond today, the price would be 105.968. Again, that's per 100 of nominal value. We know there's 1,000 of nominal value, so the actual cost of the bond today is 1,059.68. And this is where we start talking about the primary and secondary markets again. This bond was issued in the primary market for a price of 99.170. and it's now trading in the secondary market for a price of 1,059.68. If you bought this bond in 2002, you would have received the coupons up until the current date, and you could now sell that bond on for a capital gain of around $60. Okay, now let's take that same bond, the Walt Disney bond, a little stage further. What we've got on the screen are the cash flows associated with the bond when you buy it. Now, if you remember some of the numbers from the previous slide, from the Bloomberg screenshot, you'll remember that we said that in December 2002, you would buy this bond for a price of, well, it said on the screen 99.17, but we know that's a percentage of nominal value, or per 100 of nominal value, so the actual price is 99170. We also know at the end you get back the nominal value of 1,000. Now, there's the maturity date, and it looks like we're getting a little bit more than 1,000. See if you can think why that might be, why we're not getting 1,000, in fact we're getting more. Also, the amount extra that we're getting seems to be the amount that's being paid here, which again isn't a number which we've come across before. The important thing to realize is that from December 2002 until the first coupon date is only a 6-month period. We said that most bonds pay on a semi-annual basis. This one, as we saw on the Bloomberg screen, is no exception, and therefore what it pays is half of that coupon rate. Now remember, the coupon rate was in percentage terms 5.875%, and half of that is 2.9375%, or when we multiply that by the nominal value, 29.375. So this final sum that's paid on the bond is the nominal value of 1,000 plus the last coupon payment due on the bond of 29.375. Now, I even put down all of the coupons. If you think this bond is issued in 2002 and 15 years later in 2017 it matures, and so therefore we'd have 2 coupons for each of those years. So we've just kind of put the dotted lines in here to indicate there would be repeated coupons up until that final date. So something you might be thinking now is, why 99170? And also, why is the current price even more than 1,000? So the next section we're going to look at is the valuing of bonds. Now, for the exam, you do not need to be able to calculate the price of a bond giving its cash flows, because you don't have the equipment to do so. However, we're going to show you in Excel how to do this, and we would encourage you to go a little bit beyond the scope of the syllabus here and what you'll be examined on, just to check out how bonds are priced and get more comfortable with it. In the exam, we will expect you to understand that there's a required rate of return on a bond, there are coupons, and what we're going to show you now is the price of a bond, and here's the key phrase, is the present value of all of the cash flows generated in the bond. Now, you may remember from earlier modules in level 1 of the CFT, we did show you a discounting and compounding formula. The discounting formula we showed you was present value equals future value divided by 1 plus the rate of return to the power of n. Well, this is exactly the formula we use to discount each of the individual cash flows that we identify in a bond. Initially, we know that those cash flows are just the coupons, and later we know it's the coupon plus the nominal or par value of the bond as well. In each case, we're discounting it for the period, 1, 2, and finally n, the last period. And the R is the only thing we need to be sure of. The R is the required rate of return. Now, that could be your required rate of return, or it could be the market's required rate of return. If you discount the future cash flows of a bond at your required rate of return, you'll find out, when you add all of the present values up, you will find out how much you're willing to pay for the bond. If you discount it at the market's required rate of return, you'll find the price that the market is willing to pay for the bond. And taking that one stage further, if we know the price that the bond is trading at in the marketplace, which we will because it's a publicly available piece of information, we know the future cash flows, we know when they're going to happen, we should be able to arrive or derive at the figure for R, the required rate of return in the marketplace. And very shortly we're going to show you that is known as the yield to maturity. Now, to take this stage further and to help clarify what to some of you may be a quite confusing diagram with all of these formulae around, now we're going to jump to Excel, and in Excel we'll make up a simple bond and try and work out its value. Okay, so here we are in Excel. We're with our now familiar company of Walt Disney. Now, this isn't the bond that we've been looking at. This isn't the bond that matures in 2017. So we're just simplifying things down here, because what we've got here is a bond with a nominal value, also of 1,000. This bond's got a term of 5 years. It pays a 6% coupon, and the market's required return on this bond is 6.2%. Now, to make things even simpler, what I'm saying on this bond is that it pays coupons annually. Now, we know that's not the case for the Walt Disney bond we looked at, and it's not the case actually for any of Walt Disney's bonds, but it'll just make the maths a little bit easier for the first time that we've priced a bond together. So you see, all I've set up here is time, cash flow, and present value, because we know the value of the bond is the total of all of the present values. I've also said that each of these cash flows, if the bond is being issued today, to make things a little bit simpler still, if the cash flows therefore are at time 1, 2, 3, 4 and 5, each end of year from the issue date, then what we can work out is the value of each of the cash flows. Now, the cash flow therefore is going to be the nominal value multiplied by the coupon rate. Now you'll notice I've used range names to name those cells, just to make the visuals a little bit easier to follow, and therefore I can see that the coupon is going to be 60 at the end of year 1. And if I just copy that across, I'll just pause for a moment and ask you to think which of those is incorrect. Now hopefully you can see the one that's incorrect is going to be the final one, because in addition I also receive the nominal value. Here now I've got all of my cash flows, and if you think about it, if I'm trying to work out how much the cash flow is here at time 0, what I'm really saying is how much am I willing to pay today to receive 60, 60, 60, 60 and 1060. Now if you think about it logically, even before we start discounting, most of the money I'm going to pay today is going to be a payment today for this huge sum of money. I mean huge by comparison to the comparatively smaller coupon payments. And we'll see that is indeed the case. So to work out my present value, hopefully you remember the formula. You take the future value and you divide by 1 plus my required rate of return to the power of when this cash flow happens. That's going to discount 60 back for 1 year at a required rate of return of 6.2%, and that gives me a value of 56.5. What does that actually mean? It means I'm willing to pay 56.5 today, such that I receive 60 in 1 year's time. And if I do that, my return that I will achieve is 6.2%, which for this particular investment, for various reasons, such as interest rates and risk, is exactly the return I want to achieve. Now I can just copy that straight across and find that, as expected, I'm willing to pay the largest sum of money for that last cash flow. And in fact, I'm willing to pay 784.66 today to receive 1060 in 5 years' time. Now the whole purpose of this spreadsheet is to work out the price or value of the bond, and therefore if I just sum up those numbers, I will find a cash flow of 991.62. Now you may have noticed I put a little minus sign at the beginning of that and then added them up, and the only reason I did that is because I'm trying to show these cash flows from the perspective of the investor, and the investor would pay out that amount of money today in order to receive in these amounts. So just for consistency of direction of the cash flows, I put a minus sign at the beginning of that. So the investor is willing to pay 991.62 today to receive these cash flows in each of the end of those 5 years. Now to start thinking about this, the investor required 6.2%. The bond was offering 6% of 1,000. So by paying less than 1,000, the return you actually achieve is higher than the 6%. And just before we leave this spreadsheet, I'm just going to change this to 6.0. So the required rate of return now is exactly the same as the coupon. Before I hit enter, I want you to think, what is the cost or the price of this bond going to change to? I require 6% from a bond which is going to pay 6% of 1,000. Hopefully you thought that exactly the price of the bond in the marketplace would be 1,000. I pay 1,000 today, I receive 6% of 1,000. That's not 6% of the 1,000 I paid for it, that's 6% of the 1,000 nominal value. However, they happen to be the same thing, so my yield, my return, is indeed 6%. So again, just to reiterate, what we are calculating here, or what we're using or plugging in here in this case, is the yield to maturity, which is something we're going to come on to very shortly. Okay, so we've looked at how to price a bond, we know the features of a bond. We now need to drill down a little bit further into some of the more detailed features of a bond. And the next feature we're going to look at is the concept of clean versus dirty prices. Now, this sounds like a rather strange thing to be talking about, but in reality it's quite a simple concept. If we look at a bond which pays an annual coupon of 5%, now we don't need to know what the nominal value or the term is in this example, but just imagine that you're the bond investor and you own the bond at 0 at the beginning of the year, and then you're hoping to receive the coupon in month 12. Now, if you hold the bond for the entire 12-month period, you will receive the 5% at month 12 to reward you for lending the money to the company for a 12-month period. However, now let's imagine that at month 3, you decide you want to sell the bond. Now, you're going to sell that bond onto someone else. That someone else is going to hold the bond for the remaining 9 months. But when it comes time to pay the coupon at month 12, the company just pays the whole coupon of 5% to whoever holds the bond at month 12. Now that means you held the bond for 3 months and you're going to get no reward for that. And indeed, at month 3, when you actually sell the bond, we know exactly how much of that 5% paid at month 12 that's owed to you at month 3. So 3/12 of 5%, in this case 1.25%, of the nominal value is going to be added to the price at which you sell the bond at month 3. The price, therefore, that we trade the bonds is the one that includes this interest that is built up. Now, the phrase that used for this is accrued interest. And so what we would say is you're selling the bond at month 3, and the new buyer will pay you 3 months of accrued interest for that 3-month period that you held the bond, but are not receiving the coupon for. The new holder will hold it for the remaining 9 months and then receive the whole 12 months of interest at month 12. So you're going to receive your 1.25%. Now, if we just move on to that in a more formal manner, imagine if we were to quote, therefore, the price at which you traded bonds on the marketplace. Hopefully you can see that as each day passed, the amount of accrued interest building up on the bond will get larger and larger. So now we've got the same example on the screen, and you can see that what would happen is each day we start off with an underlying price of the bond. Here we just made it simple and say it's 100. But if nothing at all changed about the risk of the company or the interest rates in the marketplace, you would expect the bond to be trading at the same price tomorrow. From what we've just said, however, you'll know that there'll be a little bit of accrued interest which is built up. So the purple line on the screen here shows the price that would be quoted on the market if we decided to quote the bond dirty, including the accrued interest. Now hopefully you can see that that price would therefore go up, 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 and then at the point when the interest is paid, or in fact just a little bit before, more details of which are in the manual, then you would find the bond price falls back down. You would then see it rise, rise, rise again, interest is paid, bond price falls, and then it would rise again. Now that's where the underlying price of the bond isn't changing at all. Imagine if, as is more realistic, the underlying price of the bond is moving up and down all of the time as well. If we quoted the dirty price including the accrued interest, we wouldn't be able to tell whether a change in price was due to simply accrued interest or an actual change in the value of the underlying bond. So by stripping out the accrued interest and quoting just the clean price, we can see the actual movements of the bond's value. However, when it comes to the point where you need to buy or sell the bond, we need to work out the accrued interest and add that onto the value. This is very important because obviously if a bond is quoted clean and you buy it, then that isn't the price that you're going to end up paying, and you need to be aware of that. Okay, now building up on something we saw when we first looked at pricing of bonds, we're now going to look at the yield on a bond. Now there are numerous yields that can be calculated when it comes to bonds, some simpler than others. And the first yield we're going to look at is known as the flat yield, or indeed the income yield or interest yield. Now this is a fairly straightforward concept because all we look at is the amount of coupon you receive divided by the quoted price. So if we had a 5% bond with a nominal value of 100 and a price quoted for that bond of 90, the flat yield would simply be 5 times the 100, which is 5, divided by the quoted price, which is 90, which simply comes out to be 5.56%. Now notice that's the coupon amount for 1 year. Again, we want to be able to compare the yields on different bonds that happen to pay their coupons at different periods of time. So therefore we just take an annual or 1 year's worth of coupon. So it doesn't matter whether this pays semi-annual or quarterly, the coupon rate is always quoted annually, so we can just pick up that coupon rate, apply it to the nominal value, and that gives us the coupon amount. Now yield to maturity, on the other hand, is also bringing into the fact that if you look at that previous bond, you paid 90 for it and you got 100 back. So therefore you also made a capital gain of 10 on this bond. Now we hadn't thought of that at all. If you held this bond to maturity and this bond didn't go bust, you would make an extra 10. Think how important that would be if this bond only had 2 years left of maturity. You would make a capital gain of 10 over just 2 years. That's an extra 5 per annum, which is exactly the same as the amount of the coupon. So just looking at the flat yield doesn't look at any capital gain or loss that you might incur. To do that, we need to look at the yield to maturity. Now the important thing about yield to maturity is to realize that it is an average return, and there are some limitations on the yield to maturity, or gross redemption yield as it's also called, which again more detail in the manual. But the best way to understand this is to actually go back to our fictitious Walt Disney bond in Excel. Okay, so here we are back with our Walt Disney bond. Just a reminder, we had a 5-year bond with a nominal value of 1,000, and we worked out that a required return of 6.2% would mean I'd be willing to pay slightly less than par for the bond. We're now going to work out the flat yield and the yield to maturity for this particular bond. Now there are numerous ways in which we can do this. What we're going to do first of all for the flat yield is that's going to be fairly straightforward. It's just going to be the coupon multiplied by the nominal value divided by the price. Now you need to remember that we actually put the price in as a negative number here, so therefore this will actually come out to be a negative yield. So again, when you pick up the price, you could pick it up and change its sign, or I can just pick a minus sign in there. I don't want to show that the yield is a negative yield because in this case obviously I am paying out the cash flow of 991 and I am receiving in the return. So this is a positive 6.05%. But what that ignores is the fact that if you buy this bond for 991, you then get back 1,000 in 5 years' time. Now we are ignoring the fact that the value of money changes over time with inflation as well by doing this. However, by doing yield to maturity, we're going to look at the fact that you make the difference between the price and the nominal value, which in this case is approximately $8, and you make that over 5 years. So in addition to your 6, you're getting 8 divided by 5, so between $1 and $2 in capital gain as well. Now that's presuming you hold it until maturity. The other thing about saying it's assuming you hold it to maturity is, and this is beyond the scope of the syllabus but worth knowing, the assumption also on yield to maturity is you are holding this until maturity, and each time it pays out a coupon you are reinvesting that back into the markets at the same required return. Now with very changeable markets that might not actually be possible to reinvest the coupons in something with equal risk and equal return. But as I say, for the purpose of the syllabus and the exam, we just need to understand the basic concepts behind this. And so all I want to do now is to work out this yield to maturity. Now there's numerous ways in which we can do this. For our purposes, we're just going to use a function within Excel called rate. And this time the rate comes up with the number of periods, which is 5 years. The payment is the regular payment, which in our case is the nominal multiplied by the coupon. The future value, the present value, oh, bollocks. So what we're going to use is the rate function already built in within Excel. So the number of periods in this case is simply 5. The payment is the regular payment during the life of the bond. So in the case of a bond, that's the coupon. So the amount of the coupon, of course, is the coupon rate multiplied by the nominal value. The present value is the price of the bond, and we don't need to worry about signs here because the rate function and all of the kind of present value functions within Excel actually require you to have the signs in the correct direction anyway. So because of the way we've set this up, that's already in there. The future value is how much you get back at the end. Well, that's the nominal value, and that's all we need. The other arguments are optional, and that gives us a number of 6.2%. So the yield to maturity of this is 6.2%. So what that's doing is it's factoring in you will make a 6% return of your 1,000, and then in addition you will make 9 on your 1,000 over 5 years. So that's not much because it's 9 of 1,000, and so therefore it only increases my yield to maturity by 0.15%, but that is our yield to maturity. Now you may already notice that somewhere else on this screen we already have the number 6.2%, and if we come back up here, indeed we actually worked out that if you require a rate of return of 6.2%, you will achieve that rate of return of 6.2% by paying 991.62 for the bond in the first place. So the actions we did when we were pricing the bond were actually exactly the same. We were just given the yield to maturity and working out the price. All we've done now is the same thing in reverse. Given a price in the market, what is the market's required rate of return? That means you can look at the price of any bond in the marketplace, look at what its price is, and then derive what required rate of return the market is demanding from the bond. From that, you could then decide if that's higher or lower than the rate of return you require from the bond. And if the rate of return you require is lower than that, you think the bond is attractive because it is returning a higher amount than you believe you would want to compensate you for the risk of the market and indeed the issuer. Okay, now we've done all of the technical parts of this lesson. We now just need to look at some other features of bonds. First of all, we talk about the indenture. The indenture is the document that tells us all of the features and things specific to the bond that an investor or indeed the issuer needs to be aware of and what's being agreed. First of all, we've got covenants. Now, covenants are discussed in detail in the manual. We've got a few slides on them here, but a lot of it is just worth reading through. Now, covenant, and indeed the word covenant, actually just means a promise. It's a promise that the issuer will or won't do something during the life of this particular debt instrument, in our case a bond. Now, we're going to look at a few other covenants in just a short while. Now, another issue is the security on the bond. If something goes wrong and the company isn't able to pay all of the coupon payments as expected, or indeed can't pay the nominal value, what comeback do you have as the investor? Well, certain assets of the business may be offered as security, and a company can offer fixed or indeed floating charges over that. Now, don't confuse fixed and floating with interest rates. We're not talking about a fixed interest rate or a floating interest rate here. A charge is a charge on an asset. An asset is something, therefore, if it's charged, if the company defaults and doesn't pay you what it promised, you can go in and maybe along with other investors at the same level, you can actually go in and seize that asset. Now, if there's a fixed charge on a particular debt instrument, a fixed charge over an asset would be a specific asset, and that asset would be something like a factory, and that asset is very well defined and doesn't change. The debt is secured on that particular factory. You may indeed have a mortgage. A mortgage has a fixed charge over your house. If you default on your mortgage, the company that granted you the mortgage can come in and seize your house. They can't also seize your car because they only have a charge over one asset. A floating charge, on the other hand, is still over assets, but it's over a pool of assets. These are assets which are constantly changing. And the best examples of them would be something like the inventory, the finished goods that a company has. Now, a company can't give a fixed charge over its finished goods or it wouldn't be allowed to sell them. A surefire way of ensuring the business doesn't last very long. So instead, what we say to a lender is, if you look at my balance sheet, you can see I've always got finished goods in excess of $5 million sitting in my warehouse waiting to be sold and delivered. I want to borrow $1 million and I'll offer a floating charge over all of those inventories, which should be, I can't tell you exactly how much it will be, but it should be easily adequate to cover the liability. Now, whilst floating charges aren't as attractive to a lender as a fixed charge, nevertheless, I would say some companies simply don't have any fixed assets. So therefore, if they want to reduce the cost of their borrowing, they maybe offer a floating charge over what assets they do have instead. Again, there is a list of the types of assets that can be offered as security on both a fixed and floating charge in the manual, and indeed we're going to have a quick run through various types in just a short while. The final thing to think about in terms of how risky a particular bond is where it ranks if things go wrong. So therefore we have senior, junior, subordinated. There are lots and lots of different names for different levels that debt instruments may take, and that tells you where you rank if indeed things go wrong. Again, this is a list we're going to look at in a little bit more detail very shortly. On the screen now are a list of covenants. We mentioned covenants are promises, and we can see these are a list of covenants for a company that you may be aware of called Toys R Us. Now, this particular bond has a series of covenants. It has ones called negative pledge, change of control, limits on indebtedness, cross default, etc., etc., and you can see them all going down here. Many of these have the effect of making the lender feel safe. So, for example, cross default clause. A cross default covenant means that if I default on any of my debt instruments, so if Toys R Us failed to pay interest on one of its bonds, it would automatically be seen as a default on this bond as well. That's very important because the moment it starts defaulting on bonds, those bondholders are entitled to ask for their money back. If there was no cross default clause in, you wouldn't be allowed on this particular bond to ask for your money back until they'd also defaulted on you. Now, we're not going to go through in a large amount of detail all of the different covenants that are available, but what we do need to realize is that effectively they come into two separate categories, and that is affirmative and negative covenants. An affirmative covenant is the borrower promising they will do something throughout the life of the debt, whereas a negative covenant is saying I will not do something. So the negative covenant you can see here, I'm not going to borrow above a certain amount of money during the life of this debt, because you may have lent to me when I wasn't borrowing very much money. If I then went out and borrowed several $100 billion, suddenly you would feel a bit more nervous. By having that negative covenant in, you're reassured that that would never happen. An affirmative covenant could be something like condition of assets. If the factory is something which is being put down as collateral, then the affirmative covenant will be that that factory will be in a saleable condition, so that the value of that asset will be enough to cover the value of the debt should they actually default. A little bit of terminology on covenants just to finish, and again I just want to pick out a few of these as the rest of them are explained in full within the material, within the manual. So just a few. First of all, pari passu is a very common phrase you will hear in covenants, and it literally means with equal step, but what it actually means is you will rank equally with other people when things go wrong. Now that might not be with all of the creditors, but it'll be with the other people who are at the pari passu level, so you know someone else isn't going to get paid before you do. Cross default we've already mentioned, and change of control is another very common covenant, and that's saying if the company is taken over, then at that point you can demand your money back. Two reasons you might have a change of control covenant on a bond. Firstly, from the issuer's point of view, they may put a change of control in to reduce the chance that someone tries to take them over. It would actually be quite a good defense tactic against takeovers, because anyone taking over the company will immediately trigger all of the change of control covenants and immediately then have to buy back all of the bonds whose covenants have been triggered, in addition to buying the equity of the company they're trying to buy. Finding this extra cash may deter them from buying the company in the first place. Change of control covenant is also important, though, for the investor, the people who've bought the bonds. I may have bought a bond in a company that didn't have very much debt, and then that company gets bought out by, for example, a private equity house who specializes in leveraged buyouts. What they would do after buying the company is make the company issue much more debt, which again would increase risk and consequently make me more nervous and not happy. If I got this covenant in there, at the moment the change of control happens, I have the right, and usually not the obligation, to ask for my money back early before the bond has actually matured. Okay, the next section is on security, which is basically answering the question, what happens if the company defaults, if the company can't pay back its coupon payments or indeed the nominal value at the end. The security are the assets that are put forward initially when the bond is issued to say, well, look, if things go wrong, this is what we can do. Now, to be honest, if you think about it, when a company can't pay the cash, it's often in no one's best interest to start selling the assets of the company. Maybe the assets aren't worth as much as we were hoping, so we don't get our money back. It might be better to try and work with the company to turn them around and help them get back on track, and then start my coupon payments and my nominal value payments again. So therefore, one thing we might think when the company starts getting into trouble is we might renegotiate. The bondholders, and particularly the larger bondholders, the institutional bondholders, might sit down with the company and start to renegotiate some terms, such as some of the covenants or indeed the coupon level. Alternatively, the company could start selling assets to raise cash, not the assets that are being held as security, but unsecured assets that would raise enough cash for them to actually meet their obligations. Alternatively, the company might try and raise finance from other sources, such as equity, to help pay the bondholders. But ultimately, it might come down to the company can't manage to do any of those things, and the company goes into liquidation or administration. At that point, let's actually look at the assets that are being offered as security and how attractive they may be to bondholders. Now, there are many different types of assets that can be offered as collateral. We're just looking at a few here, and as usual in the manual, all of these are explained in much more detail. What we have here are financial, physical, and intangible assets, and we'll just give you a brief example of each one and whether they're a preferable type of collateral to offer or not. So on financial, well, the ultimate financial collateral would be cash. But you'd have to ask yourself why the company's going bust if it's got lots of cash lying around. But it certainly does have a very high quality, and it's very liquid, meaning it's very easy to turn into cash because, of course, it is cash. The next type of collateral, still under financial, would be something like receivables. This is where the company has sold something to a customer, sent out an invoice, but just hasn't received the money in yet. That again is very good collateral. It could only be offered as a floating charge, thinking back to fixed and floating charge earlier. But if we offer floating charge over our receivables, that's very high quality, because to turn that into cash, all we have to do is wait for the customer to pay their invoice. On physical, we mentioned inventories earlier, which are finished goods, which could offer a floating charge over. But you might also have, and I'll put down a common word, PPE, property, plant and equipment. You might have buildings, factories, office blocks. You might have large machinery. You might have quite expensive equipment that could be sold on. So all of that could be offered as collateral as well. Some of that could be offered as a fixed charge, others as a floating charge. And that's therefore got a medium quality. It's not as good and it's not as close to cash as the financial, but it's still quite good and certainly has a realizable value. We then come down to intangibles. This would be something like a patent. Now, a patent is where the company has the unique ability to produce a particular product or service, and that certainly has a value. Whether or not it could be offered as collateral depends on how saleable that patent is. It's also very hard to put a value on patents, and so therefore, although in certain situations they may be offered as collateral, I would say they're of a lower quality and a lower liquidity. And the final section in this lesson is subordination. Remember, this is what we said earlier, who gets paid first when things start going wrong. In an insolvency situation where we're not able to refinance, who do we have to pay back if we're the issuer when things are in trouble? Now, because the CFT is a global qualification, the actual answer to that question does depend to a degree on which country you're in. The manual does go into a few more details and even mentions a few of the nuances that you'll find around the world. However, what I can say is within each country there will be a group set by law of so-called privileged creditors. Now those creditors may be the government, who may have unpaid tax liabilities. It may be employees who have unpaid salaries. You then have secured creditors. Now those are the creditors who we said have a fixed charge over the assets. We also might have some who have a floating charge. Again, in some jurisdictions, we may find certain fixed charge creditors actually rank above some of the privileged creditors. In others, they don't. So we're just looking at this in very general terms. You then have unsecured creditors. If, for example, the company had recently bought some raw materials but hadn't paid for them yet, that would be an unsecured creditor. And also some forms of debt instrument are done on an unsecured basis. In fact, the majority of bonds around the world are typically on a senior unsecured basis, which means they're in that unsecured sector where they're just going to be, rather than having specific assets as security, they'll just be left with any other unsecured assets for distribution. But by being senior, they're at the top of that unsecured level. Then we have subordinated creditors, which often are creditors who have specifically accepted the fact that they will be subordinated or paid back after many of the other creditors. You may think, why would any creditor want to be subordinated? And it's usually the fact that, perhaps due to covenants, the company wasn't able to issue any more senior debt, and as a result, they put it down to subordinated, and they offered a very good return, and therefore investors who didn't think the company was going to default were willing to accept that higher risk for the higher return. And then finally, always down the bottom, regardless of the country we're looking at, we have the equity or shareholders. They're the owners of the business. If the company gets into trouble, they're the ones who are going to get paid back last. Now that all seems very straightforward. Again, we just need to learn the actual priority for the country in which we're operating. But then we realize that when you look at one company, that's very straightforward. But then it gets a little bit more detailed when you have group companies. One parent company may own several subsidiaries, each of whom own different subsidiaries. Those subsidiaries might even be in different countries. So therefore, the further level of detail on this are looking at contractual subordination and structural subordination. Now the simplest of the two is contractual subordination. This is simply where the contract says you'll be paid out before these people and after these people. Where it becomes a little bit more involved is on structural subordination. And remember, at any time, if you want to read all of these slides in detail, you can just pause the video and come back to it. Structural subordination is where the actual group structure of the different companies within the group lead to a decision about who gets paid back first. And this often leads to some interesting and unexpected scenarios, and so therefore the best way to understand structural subordination is to have a look at a few examples. Now the manual has about 5 of these examples. I'll take you through 2 and then go to the manual to work through all of the others as well. Now There are a few things that we need to specify before we actually start this example. First of all, there's a strict process that we need to go through to decide who gets the money. Because ultimately that's what we're going to decide. We're going to be looking at some very upsetting situations. We're going to be looking at companies going bust and running out of cash and not able to pay back their debt providers. So therefore, the first rule for all of these, and indeed the ones in the manual as well, is all obligations, unless I say otherwise, are senior unsecured. So here is a bond, it is senior unsecured because it tells me. Here is a loan, it's senior unsecured because I didn't tell you. Later on, I will say something might be senior secured or subordinated. So that's the thing to remember first of all. All obligations are senior unsecured unless I tell you otherwise. Then secondly, we're going to have a system. We're going to ask ourselves the question, how many claims does the company have on its assets? So we'll look at where the assets are, and then we'll ask how many claims does that company have on its assets. Secondly, how much is each claim? And then thirdly, we're going to rank the claims and distribute the cash. So let's look at this company. We've gone for the simplest group structure in the world, which is one parent company owning 100% of the equity in that subsidiary. Now the group has gone bust, as I said. You can see the parent company has issued some bonds and the subsidiary has gone out and borrowed some loans from the bank. Now 90 million is available to S. Now what we're assuming by this therefore is the parent company is simply a holding company. It doesn't have any assets of its own. Again, just think how simple I'm making this. Often the parent company might have assets of its own, such as, for example, a head office. There may be many other subsidiaries. The parent may even have some business of its own. But I'm going to say, simple situation, $90 million of assets that I can turn into cash are sitting in S. Now look at our three steps. How many claims does S have on its assets? Well, the first claim that S has on its assets is this one over here. That is claim number 1. And we can see that that is a loan claim, and we know from up above that that means it's a senior unsecured loan claim. Now the second claim that S has on its assets, you might be tempted to say, is this bond up here. But actually that bond was issued by the parent company. So the bondholders have no claim on S's assets. So actually the second claim is the equity claim here that the parent company has over S itself. So therefore if we have two claims, how much is each claim for? Well, claim number 1 is for $200 million. Claim number 2 is for everything else because the equity holders get whatever's left. How do they rank? Well, hopefully you can see that a senior unsecured loan claim ranks senior to an equity claim. And therefore, in this particular instance, the entire amount of 90 million is going to go here. Now, it wouldn't actually matter if this bond over here was senior unsecured, senior secured, or anything else. Ultimately, it has no claim directly on S, it has a claim only via P, and as a result that 100 million goes unpaid. Now if we look at a second exercise, in this case again we've got 90 million of assets available to S. Again we have 200 million of loans here, and again we know those are senior unsecured. This time S has other claims on its assets as well though. It still has the 100% of equity, but it also has an intragroup loan. So the parent company at some point has loaned money to S. So I'll set 3 rules. How many claims are there? Well, there's a claim here and a claim here. How much are the claims for? 200 million, 50 million, and then everything else for the equity claim. And then how do they rank? And this is the most important thing. Well, hopefully you've already decided the equity claim is going to rank lower than all of the others, and because the claims in total are more than 90 million, the equity claim is going to receive 0. But let's look at the two claims. We've got a senior unsecured loan claim of 200 million, and then we've got an intragroup loan, which we also know from the question is senior unsecured. We can't assume that, but we can for this case study because that's what we were told at the beginning. And so therefore what we're going to say is the 50 million and the 200 million rank pari passu. And so therefore they are going to not get equal amounts of the 90 million, but they're going to get pro rata amount, with 4/5 of the money going here and 1/5 of the money going here. That means 19 million of the 90 million goes here, and the balance of 72 million goes here. Again, the senior unsecured bondholders get 0. So the idea of these two exercises was just to give you an idea of how structural subordination can work. As I say, those two examples will both appear in the manual. In addition, there are a few more complex versions of this as well. Now, that brings us to the end of this lesson. Make sure you attempt the test questions that accompany this lesson. And if you have any questions, as always, please feel free to get in touch with your tutors. Thank you very much.